Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. MONEGENIX.com. And now for this week's question. Can I pay premiums monthly instead of annually? What options do I have? So you can pay for whole life. I'll address whole life insurance first and then term and universal life. So on whole life insurance, you can pay the base premiums on any whole life policy. And that does work for or a term policy too, monthly, quarterly, semi-annually, or annually. For whole life, paid up additions rider payments can be paid at any time during the year at some companies. Like I know that some of the mutuals like Penn Mutual and the Guardian, your PUA payments, they don't really care when you pay them. You can just send them in ad hoc whenever you want. For other companies, let's say like MassMutual, you can do it once per year on your policy anniversary. And I can't remember if they give you 30 or 60 days. I think it's 60, but don't quote me on that. Unless you are paying your monthly scheduled PUA payments on your policy, and then the rules are different. Other mutual carriers have varying degrees of flexibility, with most of them leaning towards a more restrictive and less flexible policy payment schedule. Usually the carriers don't want you to have a ton of flexibility. They just want you to just make your premiums and just keep paying them and don't try to switch things around too much. You can also stop and start payments on some policies using what's called premium offset. And what that does is take the accumulated dividends, or the PUAs, paid up additions, and current dividends. And it uses combined those two things to pay your base premium. And so you're essentially, with the accumulated dividends, you're basically taking money from your left hand and putting it in your right hand. And then the money's kind of recycling itself because it's going from one part of the policy into back into base premium. So it, in a sense, like, yeah, it's lowering the death benefit, lowering cash values because you're surrendering those, but then you're paying the base premium that then raises policy values back up. So you can do that premium offset at pretty much at any time during the year. Premium again, this you could switch it again with Penn Mutual, Guardian stuff. They will let you, so you must just switch it. You can switch it, and then they'll switch you on annual, and then they'll go from year to year. Premium offset uses, as I said, premium offset is using current dividends and accumulated dividends to pay those premiums. So just keep that in mind. When you switch between premium payment modes, so for example, monthly to annual or quarterly to monthly, the previous payment mode finance charge typically remains in effect until the next billing cycle. So let's say you switch from monthly to annual. Usually what happens with the carriers was that the carriers will, they'll switch you to annual, but it won't result in any discount. In other words, they're not getting rid of the finance charge for that year. And that will remain in effect until the next billing cycle. So you're just essentially like prepaying until the end of the year. So if you're on monthly, you're just prepaying monthly, but you're not getting the discount until the next billing cycle. I know this is at one carrier, just from personal experience. I know this is what typically what happens. They don't advertise it, but that's what ends up happening in practice. It's, not a terrible thing. It's just something that catches some people off guard. So switching from if you go from annual back to monthly, then they'll start charging you the modal finance charge when you go, as soon as you switch back. So other companies have similar rules. And again, varying degrees of flexibility on when you can change billing modes. You can also pay your premiums using the premium loan option, or APL, which is automatic premium loan if you forget somehow to pay your premium, which will draw a loan against your policy cash values to pay the current premium payment to make sure your policy stays in force. I've had this happen to a couple of clients, just didn't pay their premium, and then it APL'd and then their premium was paid. Not a big deal, except you have to manage the loan. And I have some clients that do this on purpose because they're paying monthly, but the monthly modal charge is actually more expensive than taking a policy loan, because a carrier might charge you 7, 8, 9% if you're paying monthly. But the policy loan is actually only maybe 5%, or maybe a little bit more, in some cases a little bit less. So you could pay a 5% loan rate and then just pay the premium and then pay back your policy loan, and you'll net the difference, which you can then add back to your policy. You just pocket it. And then finally, you can stop paying premiums altogether by requesting what's called a reduced paid up policy from your insurance company. And then that will suspend premiums. The company will look at the cash surrender value and figure out how much death benefit that cash value will buy on a guaranteed basis for the rest of your life. And then they reduce the death benefit to that amount, and then you don't pay any more premiums. And that's it. So that's it for whole life insurance. Universal life and term insurance play by different rules. So real quick with term insurance, because that's the simpler of the two. Term insurance, there really aren't any options to stop paying premiums. You pay premiums. If you don't pay your premium, then your policy lapses. That's it. There's no cash value in a term policy. There's no real non-forfeiture options on most of them. Some of them have return of premium options, but for the most part, you pay your premium or the policy lapses, and that's it. With universal life, it works kind of like whole life insurance, except that there is no guaranteed level premium. So in a UL, this is something I have found a lot of people don't really understand. In a UL policy, there is no guarantee. It's not a guaranteed product, and there's a lot of agents that sell universal life as though it is a guaranteed product, or that it's kind of like whole life insurance, but it's better because it's got some bells and whistles or whatnot attached to it. Universal life is nothing like whole life insurance in the sense that with a UL, it is a completely assumption-driven product. I said this before too, and I had this discussion with a product developer before, and basically said that universal, and he said, yeah, this is absolutely the correct way to think about this, which is that whole life insurance is kind of like you plan for the worst and hope for the best. And universal life is more like you plan for the best and hope for the best. And what I mean by that is the universal life has a certain set of assumptions built into it. And then it has worse assumptions that represent the guarantees. And the worst assumptions are always the guarantees. So it starts out higher than, in terms of the crediting rates, universal life assumes that it's always going to pay higher than the minimum. And for policy charges and mortality charges, it assumes that it's going to pay, that the company's going to charge less than the maximum charges. So if the company in the future has to charge more than the current assumed charges, and it has to credit less than the current assumed crediting rates, the insurance company can kind of squeeze those two things down together to a point where it will force a lapse on the policy, because the cash value just comes straight out of it. Lower crediting rates, higher expenses, and the cash value just starts getting sucked right out of the policy until it lapses. And the third moving part of this is that you don't have a guaranteed level premium. So if you don't pay a premium, which you're not forced to in a universal life policy, and that includes both variable life, which I don't talk a lot about, and indexed universal life. There's no real guaranteed level premium on those things. So if you don't want to pay it, you don't have to. And the insurance company's not going to automatically, deduct a premium or whatnot. If you're on a scheduled payment, they will. But you could just say, I just want to stop paying my premium, and that's fine. Nobody's going to bother you about it. They'll just keep taking the charges out, and as long as there's money in the cash value, then the charges will come out. And when there's no more cash value, the policy lapses, and that's it. Because the way a UL policy is set up, all universal life, it was just fixed ULs, indexed UL, variable, whatever, it doesn't matter. It's a term, it's essentially buy term and invest the difference. It is a term insurance, a 1-year annual term mated to a cash value account. And then the term portion of the policy is paid for by the cash value account. They just keep deducting charges every month until there's no more cash value left. The hope is that you are able to earn enough interest on the policy that that cost of the term is immaterial in the future at some point. So that's the big assumption on that. So because of that, you're not actually being charged a guaranteed level premium because it doesn't matter. That's as long as you've got money in there, it doesn't really matter. So you have the option of just paying like up to the maximum, where the MEC limits are. You could overfund it beyond that, but we're getting to different. It changes the status of policy. But so basically, you're going to pay kind of the quote unquote maximum, or you can thin fund it, what's called thin funding. You could pay down kind of towards on the lower end target, what's called target premium, or slightly lower just to keep putting money into the policy. Or you could just say, suspend premiums, I'm not going to pay it. And you have a range of premiums all within there. And you could change them every month if you wanted to. Like there's nothing that says you have to keep paying the same premium. As long as there's enough money in the cash value for charges to come out, insurance company doesn't really care. So that's it. And the other thing that goes along with universal life is there is no option for a reduced paid up policy. Universal life never gets paid up. What you have to do is have to say, you would reduce the death benefit to a point where the charges are getting smaller, and hopefully, your premium, when you're making premium payments and the interest credits going in, hopefully that doesn't, mech your policy. But there's no way to do like a reduced paid up because the whole idea of the term component is that you just keep paying on the policy and it never gets paid in full. So it just doesn't function like a whole life policy at all. It's not supposed to what they call endow. It's not supposed to endow or become paid up. So that's kind of the other difference. And the other reason why there's no guaranteed level premium, because there's really no end point on a UL policy. The main exception to this is what's called guaranteed universal life. And GULs, or guaranteed universal life, is where the insurance company takes and they add a rider to the policy. Because with a UL, it's all assumption driven. So what the GUL tries to do is it tries to establish a death benefit that's guaranteed level. It doesn't increase. It's just if you buy 100,000 of insurance, it's just guaranteed level. There's really no cash value or very minimal cash value in a GUL policy. So what happens is the insurance company says, okay, we're tacking on this rider and we're going to make a no lapse guarantee rider that goes with this policy. And as long as you pay your no lapse guarantee premium, they don't call it a guaranteed level premium. It's a no lapse guarantee premium. So as long as you pay this, and you have to pay it on time. You can't pay it early and you can't pay it late because that screws up how the guarantees work and how premium's allocated. So you have to pay it just on time. And then as long as you do that, the policy, the rider will guarantee the policy stays in force. And sometimes I've seen companies where they have the setup where it'll stay, you can pay premiums for, let's say, 10 years, stop, and then the guarantees will carry it all the way out to age 120 or whatever. So that is, but it's accomplished through a rider. It's not actually built into the policy. And you can lose that rider and you can lose the guarantees if you don't pay your premium. Like if you pay it late or you pay it early. And late meaning like you could just pay it like one day late. And some companies might suspend, depending on the terms and conditions, the company could suspend the guarantees on it. With a lot of companies, they might give you a grace period of a couple of days, but typically what happens is if there's a grace period, it's not very long. The premium, because of the way the policy works and the riders work, it has to be paid on a specific time, and everything's really, really sensitive, payment sensitive on those policies. So you don't necessarily have this. It's not, and again, doesn't go on a schedule like whole life insurance does. So you have to make that premium or you lose the guarantee, the no lapse guarantee, and then it just becomes, just like a kind of an ordinary UL, and you're just hoping that it's going to it usually won't stay in force because it won't be enough to keep it in force. But you're kind of hoping that you could if you lose that no lapse guarantee. The policy essentially becomes worthless if you lose that. So it's just a fundamentally different product. when you're talking about universal life. And it does introduce a lot more complication and so on and so forth. So, but essentially, when you own a UL policy, you can pay the same, just like whole life insurance. You can pay monthly, quarterly, semi-annually, annually. But just know that there's the outside of that, there really aren't the same sort of options that you would get in whole life insurance. And then term insurance has even fewer options. It's because it's stripped down even further. So in terms of payment options, you're more, quote unquote, I'd say flexible, is going to be with whole life, just because of, in a sense, it's the rigidity of the policy. Like, it has a certain period of time you're going to pay, and then it's paid up, and then they give you flexibility in how that happens. And that's just baked into the product, how the product works. I hope this helps. And that's it for this week. So I will see you next week.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.